We are looking at the best stocks to buy for 2024. This is from a Forbes article which was released just a few days ago. We are going to pick 3 of what we believe to be the best stocks from this article. And as always, we will analyze each one. We will run them through our very own valuation model, getting to what we believe to be the intrinsic value and acceptable buy price of each company. And as always, we will look at those financial metrics. So let's take a look at these stocks that Forbes do highlight in this article. And firstly, we're going to take a very quick look at the introduction. Now, what they're stating here, with the S&P up having a strong year, the Nasdaq up even higher at 35% year to date. Now, they say this gives a false sense of a great year that was 2023 for the stock market. But when you boil down, they say the best companies were notably the mega caps, the likes of Apple, Microsoft, Alphabet, Amazon, some of these up over 50% year to date. And essentially they do say that for the majority of companies, and even more so the smaller caps, they did have a very, very different story in 2023. They say some of them took the biggest hits and were held back from realizing what they believe to be their true worth. So in today's episode, we're going to just take a selection of these 12 best stocks. We're going to take a look in detail as to whether or not these are ones you should be including. And we're going to jump off with the first one in the article, which is Vici Properties. Now, they have a market cap of just under 30 billion. It is one we have spoken about on the channel, one that I have been buying over the year. And we can see their performance over the last 12 months. It hasn't been the greatest at all. And we will shortly jump into what we believe analysis of their historical performance as well as those dividend safety metrics. So when we do take a look at their essential investment thesis for Vici Properties over the next 12 months, we can see, for those that are new, Vici does boast a very strong portfolio, over 49 hotels, casinos with significant hotel rooms, and a lot of very strong companies that you would have known in terms of those hotels that have been leased. We're talking about a lot of very big ones. Caesars Entertainment, notably Hard Rock International. Now, the reason for this, they are saying essentially Vici expects their 2023 full year revenue to be up 38.2% from the prior year. They're expecting their funds from operations to be up 11.4%. And we can see here that they believe their free cash flow of $2.09 more than amply coverages Vici's $1.66 in dividends. On top of that, it's not just them who are looking to add this or continue to add, but billionaire investors who have been laying down big bets on Vici in recent months. They talk about Stephen Cohen's Point72 Asset Management that added just under 400,000 shares in 2022, as well as essentially Ken Griffin's Citadel owning around the same amount at 308,000 shares. So let's take a look at Vici Properties, and this is one full disclosure that I hold in my own portfolio. It is essentially flat year to date. It is in the midpoint of the 52-week range with a yield of around 5.3%. Now, if you have been holding this over the last 5 years, you would be up around 74%, which is fairly positive in my opinion, bearing in mind this doesn't include those dividends reinvested. So let's take a look at the dividend safety score. We see 50 borderline safe, 33 billion market cap, a large cap company. Now, this wasn't one that was essentially around in the recession, so we can't look at those recessionary metrics. Dividend growth, though, 6.4% increase this year in September. It is above that 4% that I do advocate on the channel, so that is positive to see. And since inception, they have been increasing that dividend, as we can see, 4 years of consecutive increases. Now, dividend yield theory, for those that are new, states that the company is undervalued when the current yield sits above the 5-year average. 5.24% above 5.03, so we have a sign of undervaluation, but as always, we never conclude in any model in isolation. Forward P to FFO 14.3, slightly lower than the 5-year average of 14.8, and if you want to compare it to the real estate P to FFO, it is essentially in line. So let's take a look at some metrics. Now, typically, free cash flow is what we focus on. The earnings that we do look at is susceptible to manipulation. However, for REITs, we look at the adjusted funds from operation. It is a lot more relevant, as free cash flow payouts are essentially more volatile. Hotel REITs below 75%. What we can see here, it has been pretty much around that level over the last 5 years. 2023 is expected to be around that level too. So we should expect next year to see again above inflationary increase to the dividend. Adjusted funds from operation, well, very nice to see consistent increases year on year. We did see that huge year from 17 to 18, but since then it has been increasing in a very positive manner. 212 expected in 2023. Now, sales growth 5 to 10% is what we focus on as REIT investors, and we can see the last 3 years very positive, very strong double digits to the top line. 2023 no different with 54% expected. And if you want to look at that numerically, well, 200 million in 2017, 2.66 billion in 2022, and again we see a very nice jump in 2023. Now, one thing to note with REITs, essentially they do issue equity, they do dilute your position as a shareholder. The reason for this is to fund their property acquisitions. As you saw, they don't retain a lot of that internally generated cash flow as they pay a lot of that out in dividends. So just take a note with REITs, some REITs do dilute your position much faster than others. 228 in 2017, 880 in 2022. Now, ROIC for REITs, 3 to 5% is what we look at to ensure management are able to effectively allocate their capital. And what we can see here, it has been pretty decent in my opinion, 5% in 2022 at the upper end, with 2023 at 8% showing me some strong signs of management and the way they are able to operate this company efficiently. Operating margin, yes, it is fairly inconsistent, but still very, very high numbers. It is very positive to see. Remember, the higher the operating margin, the higher that bottom line net margin should be, which means essentially nicer dividend increases to the investors. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization shows us two things in fact. It shows us the balance sheet strength as well as that dividend safety. These are the number of years it would take the company to pay off all of their debt net of cash on hand. Now we're looking for around 3.5 or lower, so it is fairly high for Vici, 6.46 in 2022. Positive to note, it is coming down in 2023, and 2024 they are expected to bring this level even lower. So for me, it is giving me comfort in the way that management is moving in the right direction for Vici Properties. Now let's jump into the valuation, and typically for viewers who do see this channel regularly, we jump into every single model. We have Graham's valuation, REIT's model, we have the dividend discount model, and the discounted cash flow model. Today's episode will jump straight into the valuation output, and for REITs, just to note, we don't typically use Graham's valuation. It isn't applicable, so let's jump straight in. Intrinsic value for Vici is coming to the average of these three models at $38. Now, with the current price around $31.66, we start off with a margin of safety of 10%. If we believe it has a wide moat, strong financial metrics, good forward-looking data. So at 10%, if you believe that to be the case, it would be a buy up to $34. At 15% up to $32, and at 20% we can see it's around $1 shy. So essentially with our analysis, we believe you are obtaining around a 15 to 20% margin of safety for Vici Properties. In terms of Wall Street, well, they do see some upside at around 15%. So in conclusion, for Vici Properties, we see around a 15 to 20% margin of safety, with Wall Street looking at around a 15% upside over the next 12 months. The second stock that we are looking at today is Muller Industries, ticker symbol MLI. Now it has a yield of around 1.4%, a market cap of just 4.7 billion, and we can see it is a mid-sized company with three distinct business lines. We have piping systems, we have climate and refrigeration products, as well as industrial metals. Now they do have around 20 independent business lines that essentially specialize and operate in the market segments, and what we can see, it has had a fairly strong 2023, and we will take a look shortly at those essential metrics and year-to-date performance. Now when we take a look at exactly why they do believe to be bullish on this company, why it has made the list, well, what they say is essentially it receives very high marks from the few of their value models. Now they talk about the different models that they use, but they say this company is essentially in the top 24% of all stocks based on the immediate term momentum, and in fact in the top 1% of all stocks based on their fundamental momentum score, which tracks trends, earnings, return on equity, return on assets, accrual operating profit to equity, as well as a few other strong metrics. So we can see they do believe this company, in their opinion, to be undervalued and the intrinsic value to be significantly higher than the current trading price. So let's take a look at this company. We can see it has had a phenomenal run year to date, up 63%. right at that 52-week high. But bear in mind, as we always say, just because a company is at a 52-week high, it doesn't necessarily mean it's overvalued. And you could argue that sometimes people do add to stocks that may be classified as losers at their 52-week lows, when in fact they should be adding to their winners at 52-week highs. But that is something we can discuss at a later episode. Yield, as we mentioned, 1.27%, and if you have been holding this company over the last 10 years, you would be up 227%, excluding those dividends reinvested. So let's take a look at this company. Let's look at their metrics. We don't have a dividend safety score just yet. We see the market cap around $5.5 billion, a mid-cap company. Now, in terms of dividend growth, well, that's very, very nice to see. Last full year, 92%. Last 5 years, double digits, 20% on average. Last 10 years, we're looking at 17%, so very positive to see, well above that minimum 4% I advocate on the channel to keep up in line with inflation. Now, when we take a look at some of the fundamentals, now we do see in 2017 where they reported a loss, that free cash flow payout looks negative. But other than that, 2018 to 2022, the more recent years, and in fact over the large part, it is below even 20%. 2022, 8%, 2023 expected 10%. So we do expect essentially this company to essentially offer a more double-digit increases in 2024 and beyond. Free cash flow per share, well, 78 cents in 2013, 6.15 in 2022. Very, very strong, very good performance over the last 10 years. Yes, it hasn't been very consistent. We do see some years where it does drop and does pick up again, and we do see a very strong performance. But also note, 2023, it is expected to drop very slightly, but this could be potentially a fast-growing company. Sales growth, some years of double-digit increases, some years of negative, so you could argue there is some cyclicality in the industry, which we can look at further in other episodes. 21, very strong performance. 2022, still within that 3 to 7% we look for year to year. 2023, a slight pullback to the top line at negative 12%. And when we look at this over the longer term, they have essentially nearly doubled their top line over the last 10 years, 2.1 billion to 4 billion. Shares outstanding, they don't really do much. As we see, it has barely moved over the last 10 years. In fact, it was gone from 113 to 113. So they don't do share buybacks, returning excess cash to investor pockets. But at the same time, they also don't dilute your position as a shareholder. ROIC, minimum 10% for companies that aren't REITs, so we can see how effective management are. 47% over the last 2 years, 34% in 2023. So this is very positive. This is what we love to see as investors. Operating margin, free cash flow margin, a bit more to be desired for on the operating margin front, although do note it is increasing, which is positive to see, something I would personally keep my eye on over the next few years. Likewise, free cash flow margin, around that 7% target we like to see, very nice in 2022. 2023, 19% is also very positive. Net debt to EBITDA, fantastic, 0 in 2022, essentially meaning they have a very strong balance sheet. It wouldn't even take them 1 day to pay off all of their debt net of cash on hand. So let's jump into the valuation model of MLI, and as always, if you enjoy the content, value is being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, then do click on that pinned comment below. So we have an intrinsic value of more than double the current price at $109, $48 current price. So if we start off with a margin of safety at 10%, we can already see it is a buy. Even if we jump to 40%, it's still a buy. At 50%, we do still see signs of an acceptable buy, and at 55%, pretty much around the current trading price. So when we do run through the intrinsic value calculator, we can see that for every single model, it is showing strong signs of undervaluation. And do let me know at the end of this episode if there are any of these stocks we run through that you want a full detailed analysis on, that we typically do on the channel, and we can really focus in on those companies. Now, when we look at what Wall Street say, well, Wall Street slightly less bullish, not only than our intrinsic value, but also than the Forbes article, who also see some strong upside. They believe there to be around 5% upside. So in conclusion, we see around a 55% margin of safety for MLI, with Wall Street only seeing around 5% upside to the current trading price. We now move on to the third company, which is Sprouts Farmers Market, ticker symbol SFM. Now, this isn't one that pays a dividend just yet, but has had a very strong performance. We can see market cap, again, very small, 4 billion, and it is essentially a Central Sprouts Farmers Market company. It's specialty retailer of natural and organic foods. They have over 400 stores across 23 states, and they believe that they are positioned well with a country that essentially is experiencing population growth as well as migration. We'll take a look at this shortly, but we can see it has had a very strong year in 2023, and what they believe, very similar to MLI that we just reviewed, it is in the 1% of all stocks when they do take a look at major investing factors, which includes value, quality, momentum, as well as low volatility. So essentially, Forbes article, this is company number 12, and I can pin this essential article into the comments so you can take a look for yourself. But they believe for value, it is very cheap, a very high quality company, very strong momentum, as well as low volatility. So let's take a look at this company. Now, year to date, up 55%, again, at that 52-week high. Now, when we take a look at the performance over the last 10 years, we can see it is up around 27%, but bear in mind this does depend on at what point you did buy this throughout the 10-year period. So let's look at the metrics. 5 billion market cap, a mid-cap company. Now, in terms of the free cash flow per share, 54 cents in 2013, 2.29 in 2022. So it has grown very rapidly, although we do note some inconsistencies. It did take a while for this to take off. 2023, it is expected to be an increase on 2022. Now, in terms of sales growth, they did start off with some rapid double-digit growth year on year. It has started to slow down. 2021, negative 6%. 2022, it is still within that 3 to 7% we look for, as well as expected 2023. But there does remain to be a question as whether or not it has had all the growth it is expecting in terms of rapid growth, and we will just see around inflation or above inflation increases year on year. Numerically speaking, well, nearly 3 times growth to the top line, 2.44 billion in 2013, 6.4 in 2022. Now, they do share buybacks. As we can see, the shares outstanding has decreased over the last 10 years, 140 million in 2013, 109 in 2022. So that is positive to note as an investor, that they are returning excess cash to investor pockets. They may not be doing a dividend, but they are returning essential excess to investors in another way. Now, ROIC, very positive to see, above that 10% I look for nearly every single year. The last 2 years, 13, 14%, 2023 expected the same. So there is a lot to love with this company. Now, one area that I do find this industry does struggle in is with the margins. As we can see here, 6% margin, it isn't the greatest. If the consumers are getting squeezed, then we can see that companies like SFM may start to reduce their prices to entice more customers to spend. But then again, how low can they go with the operating margin squeezed, in my opinion, around 6%? Something just to bear in mind. Free cash flow margin, a fairly similar story here too. Now, net debt to EBITDA, more positive as we can see. The last 3 years below 2. 2023 expected 1.78. So that is still fairly positive in my opinion. Now, when we jump into the valuation model for SFM, we can take a look at what we believe to be the intrinsic value. And as we can see here, $56 is what we arrive at. Now, the current price is around $48. So when we start off with a margin of safety of 10%, we can see it is a buy up to $50. When we move this to 15%, it is pretty much at the current trading price. So for SFM, we believe there's around a 15% margin of safety. What do Wall Street say? Well, they believe the share price to have around 5 to 10% upside. So in conclusion, for SFM, we see around a 15% margin of safety, with Wall Street expecting around 5 to 10% upside over the next 12 months. So it is always interesting to see. You do have articles that do believe they are very bullish on certain stocks for different reasons. But when we do take a look at Wall Street, we do see that they don't always concur with the same reasoning. So it is interesting, and we do always include what Wall Street have to say because it does gain a better picture for the investor. As always, if you enjoyed the content, if you want more of the same, do let me know your thoughts in the comments below. I will like to put out more content that you as the viewers do like to see. So if you let me know whether you are liking some of this different content we have been doing over the last few weeks, then we will continue to stick to do so. As always, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, or if you want to run through companies on your watch list to see at what price they should be obtainable at the acceptable buy price, click on that pinned comment. As always, catch you on the next episode and take care.